Okay, we're back for part 2 for futures trading in the sequence on futures trading for Economic 136. And this slide set has a really long, complicated title: The Impact of Theoretical Pure Arbitrage Upon the Upper and Lower Price Limits of Storable Commodity Futures and Indexes. This is actually a very important subject. You can't trade futures without understanding this as well. To motivate this, I have this picture taken many years ago of Mauna Kea, their famous 180-yard third hole over the bay. And as I say here, a good round of arbitrage might get you a good round here. This is where you can play golf if you do well with arbitrage. I bogeyed this the first time with a routine shot, and I parred the second time by hitting a lava outcrop down there near the bottom of the hole. I hit the ball on the top, but I got a lucky bounce onto the green. So sometimes luck helps, but luck's not an issue in arbitrage. In the purest form of arbitrage, if you're able to undertake it, you are guaranteed profits. So let's talk a little bit about that and the impact of that upon upper and lower price limits on futures contracts. Before I go, I want to make a couple of corrections. When I had this in part 1, the bottom line was incorrect. Monday through Friday trading break is not from 3:15 to 3:30. It's from 4:15 to 4:30. And I decided also that the whole thing was poorly worded. So let's try this all over again. Here we're saying the trading is 6 days a week, and there is no trading all New York time, Sunday through Friday, 1 hour from 5 until 6, no trading then. Monday through Friday, there is the trading break from 4:15 to 4:30, and that's, of course, just before the market closes. And then trading stops on Friday at 5 p.m. There's no trading on Saturday, and trading resumes on Sunday at 6 p.m. So you have Saturday off, so that maybe is a little more clear. And then there's one more, not so much correction, but SPX usually refers to the actual S&P 500 index, the index itself, although a lot of people, including me, are in the habit of calling the big contract on the CBO Futures Exchange the SPX contract. It is the case that ES is the symbol of the SPX futures contract, just to make sure that's not too confusing. Let's get on with this. Okay, pure arbitrage takes advantage of the fact that two or more commodities or financial assets are mispriced relative to each other. And with true arbitrage, an automatic profit will be realized. And usually arbitrage involves taking a long or short position in the primary asset and taking an opposite position in its derivative, or at least the kind of arbitrage that we're talking about here. And I'm going to give you an example, an exaggerated example in gold and a gold futures contract. So this would be, it's easier to explain this by example, I think, than by trying to explain the concept. So let's start this. Suppose the spot price of gold is $1,200 per ounce. So that's information we have. Suppose that the 1-year future price of gold is $1,800 per ounce. It's just there, 1 year out, $1,800 per ounce. The interest rate for borrowed money, we'll say, is 5%, or $60 per ounce of gold, because an ounce of gold costs $1,200. The storage cost of gold, let's say, is $40 per ounce. And the insurance cost for gold is $20 per ounce. And the initial margin on a futures contract, let's say, is 10% of the price of gold, and the interest charge on that is 6%. And so, can we do arbitrage on this combination of prices and make a profit? The answer, of course, is going to be yes. Now, we're not learning this, by the way, because I'm going to show you a program for doing this kind of arbitrage. We're doing this to support the theory or the explanation for why commodities that are storable have upper and lower limits on their prices. This kind of arbitrage does take place, as we'll see in SPX, but it's done only by high-speed traders. It's not possible or accessible for anybody else. So, anyway, suppose this situation presented itself, what would we do? Well, for one thing, we would borrow $1,200 and we would end up paying $60 in interest. With that, we would buy, store, and insure 1 ounce of gold. At the same time, we would sell or short a futures contract for $1,800, and we would pay interest on the initial margin of that. Now, down at the bottom of the slide, it identifies a term called carry cost. And it says carry cost is the cost of being in a futures contract, sometime expressed as a percentage of the value of the contract. This consists of financing costs, direct or implied, plus storage, transportation, and insurance costs for relevant storable commodities. So that's the definition of the carry cost. And for a commodity as complex as gold or natural gas or oil, almost all of these components of the carry cost will be present. As we'll see later, though, for FX contracts or currency contracts and for indexes, there's only one carry cost, and that's interest. Right now, though, our carry cost is complicated, and it's equal to $126. So what we're saying is if we take these 4 steps that we've already outlined and do that, no matter what happens to the price of gold, goes up, goes down, goes sideways, you are guaranteed an arbitrage profit of $474 per ounce. It doesn't matter where the price of gold goes. So the big question is, why is that? Well, it's easiest to show by example, and these are some examples of the various prices that might be the spot at the end of the year. And I'm not going to go through each line of this and explain why the profit is always $474. I'll go through the top one and maybe the second one, but you can go back and look at the slide set and convince yourself that no matter where the price of gold goes, the profit on this arbitrage is going to be $474. So this is not a type of statistical or probabilistic arbitrage. This is arbitrage if those were actual prices that would guarantee you a profit. So in 1 year, you sell the gold that you bought for $1,200 at the new spot price, and these 6, not 5 possibilities are shown below. And then you add the gain or loss on the margin account because you were short at 400. So the margin account grows when the price of gold falls. And so if, for example, the spot at the end of the year was 1,000, if we go back and take a look at the original price was $1,200 on the gold, and we had a short contract for $1,800. So at the end of the year, the spot at the end of the year is $1,000. You have a spot loss of $800. You have in your cash account a gain of $800. So loss of 200, gain of 800, and the carry is 126. So in that case, the profit is 474. Just to skip to one where it's profitable, the spot at the end of the year, let's say, is 1,600, the fourth one down. Then the spot gain or loss is, in this case, 400. The margin gain is 400, or the margin gain or loss is 200, excuse me. Subtract 126 from that, and you get 474. So by these examples, this is why, if you see this mismatch in the spot price and a futures contract, then you can either buy the commodity, go short the contract, and deliver the commodity to honor the contract on deliverable contracts that are storable, and that would guarantee arbitrage profits. And that's true pretty much for any storable commodity, especially storable commodities that have delivery conditions, as all the older traditional commodity, the commodity futures contracts do. So therefore, This reality puts a futures price upper limit, and I'm showing you the continuous model of that, although I have an example of the discrete down there at the bottom. And I say here as a note, this limit exists for storable commodities only if storage is truly available. So I'll come back and talk about that briefly. But if the commodity can be stored, then because the arbitrage possibility in the previous example would result in heavy purchases of gold at spot, raising the spot price, and heavy sales of gold futures lowering the futures price, the spread in prices would narrow. Now, as I said, this kind of arbitrage actually does happen. It mostly happens on indexes, but of course, the very activity of pursuing the arbitrage possibility very quickly stamps out the probability, or possibility, I should say, of making a profit. And therefore, of course, this kind of arbitrage is only the domain of high-speed traders. This implies, continuing here, that given borrowing, storage, insurance, and other costs, there is an upper limit on futures prices for gold and similar commodities, including oil and natural gas. And that limit is indicated by this formula here. Now, that's the continuous example where it's simply a compounding formula. Interest rate plus storage plus insurance plus the interest rate on margin times t as an exponent to the power of e. Down there in the bottom where it says discrete, that's the one you normally see in textbooks and is referred to. It's, of course, 1 plus that to the power of t. The FPUL is the future price upper limit for t equals days in the contract divided by 365. So each contract will have its own FPUL. Interest rate for borrowing, storage cost as a percent, insurance as a percent, and initial margin. Now, again, sometimes you would say, how can crude oil therefore go into such severe contangos? Because this tends to eliminate the possibility of a contango, if you think about it, or at least a severe contango. It is the case that the commodity has to be storable for you to exercise this kind of arbitrage. And sometimes natural gas and crude oil has no practical available storage. Natural gas, because storage is limited, because they store natural gas in large caverns, usually former salt mines and the like, and there's only so much of that available. They can put more natural gas in caverns that they have by increasing the pressure, but there's a limit on that. And when crude goes into contango, as it is right now, then oil companies try to lease tankers that are out of use to store oil in these tankers, just floating around in various bays and so forth around the world, hoping to be able to deliver the oil in the future. When oil prices are really low, like they are at the time I gave this lecture, there's a lot of storage of oil by the large traders in actual old tankers that are no longer operational. That story has appeared a number of times in newspapers like the Wall Street Journal and the Financial Times. Okay, that's our upper limit given our carry cost. And there's also a lower limit that one can conclude, but what this implies, therefore, is there is a constraint to the range of futures prices going out from spot and compared to spot that is indicated by this diagram here. The upper range is the formula we just saw. The lower range is a discounting version of the same formula. In some cases, one or other of the variables are missing because you don't have to store, for example, if the situation is where the futures price is way below the spot price. So this is why sometimes it's not possible in natural gas or oil, as I say, because sometimes the storage is not available. So this therefore means that you need to understand where these price ranges are. Now this is, for example, always a situation in natural gas. So here's natural gas when natural gas is at $2.50 per decatherm. And right now it's considerably below that. If you look at natural gas, because the storage costs are fairly high and sometimes the storage capacity is limited, you will see natural gas in a contango. or what appears to be a contango. At least prices are going out from the spot price as the futures prices get more distant, which is more or less represented by the red line. If that red line is steep because of high cost of storage, or it's non-existent because there is no storage, then natural gas can go into a mild contango if the storage is expensive, and a severe contango if storage doesn't exist at all. You may recall from their introductory futures material that backwardation is the opposite of contango. When oil prices or natural gas prices in futures fall as they go out, that is referred to as backwardation. And so there is going to be a trading range for natural gas that is highly dependent upon the availability of storage. And people who trade natural gas really understand that. Here in this example, we're looking at a 12% carry or an 8% short decay for natural gas, which is probably where it often is. Now, this is not very interesting for us in oil and natural gas, although when we get to the next lecture, part 3, which is about contango specifically, we are going to be able to use currently crude oil as an example because it is in at least a slight contango at the present time. And so we can talk about some contango strategies when we get to that. But this material here, when we talk about the upper and lower limit, pertains more to indexes and currencies, and especially indexes. So let's talk about that. So here we're going to start talking about arbitrage and directional betting with the SPX, S&P 500 portfolios, SPY, options on SPX, and other indexes. We're not going to cover all of those in this lecture, but all of those could be covered in this lecture if we wanted to add a component for every one of them. I think from the one that we do cover, you can generalize to the others. So arbitrage with the S&P 500 SPX futures contract is the historical basis of what is now called program trading. And it was program trading that was thought that compounded the severity of the 1987 stock market crash on, I think it was October 19th, 1987. There was apparently a program trading glitch, and they were doing this kind of arbitrage. Again, this kind of arbitrage is done now. That's what keeps these indexes in alignment, but it has to be done and can only be done by high-speed trading operations. It can't be done by retail traders with fast computers. This kind of arbitrage is done by buying a portfolio of the S&P 500 stocks or an index mutual fund or SPY, and at the same time shorting one of the SPX futures. And this is a closed contract. It could also be done in the reverse way, where you short SPY and go long on SPX futures. Generally, you are buying the stocks with the intention of delivering them or the equivalent when the futures contract expires, which of course can be done with SPY. So why would you do this? Why would you buy a portfolio of S&P 500 stocks if you were a large trader, or buy the components in a mutual fund if you were a large trader, or buy SPY in large quantities if you were a large trader, and short one of the SPX futures going out, which are the ES futures? First of all, let's make sure that we understand, oops, I lost mine. Okay, let's make sure we understand what futures we're talking about here. Now, we've talked about these a little bit in the first lecture, the first part of this lecture. So here we're referring to the SPX, ES, and MES futures contracts. And so SPX itself, again, as I said, is actually a reference to the S&P 500 index itself. So this is mid-March 2020. The index today, I think, was at 2630. We're just saying 2600 here. The contract months for all of these are June, September, December, and March. And then they have 3 additional December contracts. So they don't have monthlies, but there's no reason to have monthlies for the reason I'm about to explain on the limits on their prices. So when we take a look at the S&P 500, the big contract, the multiplier size is 250 times the value of the index. And so the notional value today, assuming the $2,600 price, is $650,000. That's a giant contract. 1 point in settlement affects $250, so 2,600 to 2,601 long would increase your margin account or your cash account by $250. And the maintenance on this is a whopping $60,000. So we won't be trading that. Although this is the only one that's deliverable. The E-mini S&P 500, as we know, has a multiplier of 50 times the S&P 500, so the notional value there is a much more manageable $130,000. 1 point movement in settlement is $50, and the maintenance margin is only $12,000. Although that's not necessarily true for the small trader, but the micro E-mini S&P 500, which you can trade, I can trade, and your little brother and sister can trade, is only 5 times the size of the S&P 500, of the SPX, and its notional value is $13,000, and 1 point settlement is $5, and that's tolerable. Maintenance on this, though, is considerably higher at $2,380. That's the broker's maintenance I told you about in part 1. That, by the way, has been changing every day a little bit, and so, as has been on the oil contract. The oil contract came down a little now that oil has settled down. Anyway, for the micro E-mini, the margin for the micro E-mini, as it says in the footnote, is my brokers, Interactive Brokers, much higher maintenance margin on this contract for small traders. So your maintenance margin is higher on these and would be for you as well. Now we have these kinds of contracts for the Dow Jones Industrial Average, the NASDAQ 100, and the Russell 2000. None of those have the large super contract. They only have E-minis and micro E-minis. So there's no major Dow contract like there is for SPS. And in this example, we're sticking to the SPS contracts. Now, here's a question you have to figure out the answer to, all right? Let's talk about what we've often referred to, or sometimes have referred to, as anomaly arbitrage in the class. Remember, anomaly arbitrage is when we have these computer programs that are tracking futures prices or options prices, and they're looking for constraints and parameters of the kind that we're describing here, and they describe a price. It tells you about a price that is anomalous, meaning outside of the acceptable range. So suppose we have a tracker that's doing this. Now, no tracker is ever going to pose a problem like this because this is an exaggerated example. But right now, short-term interest rates are very low, less than 1%, and the Federal Reserve is ensuring that large institutional borrowers can borrow at these low rates. So let's assume that the carry interest rate is 1% annual, which it's actually lower than that right now. We'll assume it's 1%. So I'm using the actual values from today. On this day, on March 26, 2020, the S&P 500 closed at 2630.07. It's up quite a bit over the last 3 days, but still way below the peak that we saw a few weeks ago. The recent market peak, seen only weeks ago, was above 3,200. So what if we were all highly confident, for whatever reason, that the S&P 500 would actually return to 3,200 within 1 year? What if we all thought that was likely? What if we thought this decline that we've been experiencing is really not logically justified, and we believe that there's going to be a quick recovery from the problem, and that the Dow and the S&P is just going to climb right back up to its peak and proceed? If we all thought that, would the ES futures contract, which is the SPX futures contract, 12 months be at this expected price if we all thought that? Is it possible for it to be at this expected future spot price? And here I'm introducing a term, expected future spot price, which is not the same as a futures price, certainly not here. Expected future spot price is exactly what the term implies, what we think the future spot price is going to be, the price on that day of the trade. So here's sort of a diagram that says, is this possible? Spot right now is 2630. Is it possible for 12-month futures to be 3,200 because we all think that that's where it's going to go? The answer is no. It's not possible for this to happen. The 12-month futures contract can be no higher than about 2656 right now. no matter what we think of the future spot price. Now that's kind of interesting, isn't it, if that's true? But let's pursue the logic of this first. First of all, we short one 12-month ES contract of notional value is $800,000. Now, as it says up there, and we've already said, the only carry cost for index futures is the interest rate, including the interest rate on the maintenance margin. Okay, so we short one 12-month futures ES contract if that's the price, because that's an anomalous price. Maybe everybody thinks that's the future, but if we actually see that price, we do this trade because our computer program says jump in this trade, you'll make money. Short one 12-month ES futures contract. We borrow $657,500 plus $60,000 more for our maintenance margin at 1%. For the year, the interest cost on that will be $7,175. Okay? So with that money, we buy long the equivalent of 250 positions, because remember, the index futures contract is keyed to that, 250 times the index. We buy the equivalent of 250 positions in a market basket of SPX stocks, which you do if you're a very large trader. You can buy them from and sell them to mutual funds, or SPY if you're a smaller trader, which would cost $657,500. If you were using SPY, you would simply buy $657,500 of SPY, and therefore that amount divided into the per share cost of SPY, which is not exactly matched up with the SPX. You could do this with SPY. And then in 1 year, deliver the SPX selection or SPY to satisfy the deliverable on your futures contract. So you would hold the short, because it is a deliverable contract, all the way to expiry, and you would let it expire, and so you would have to honor the delivery conditions, which for you is you have to deliver the stock rather than take delivery of the stock, so you deliver the stock, just like you were able to do. You've held it for a year, you're able to do that. And your profit would be $142,500 minus $7,175 is what you paid for interest, and the $142,500 is the spread between the futures price and the spot price, and you would make a profit on that of $135,325. There's no way around the fact that you would make that profit, because again, this is a deliverable commodity. It's technically a storable commodity because you store an index by simply keeping the bookkeeping entry of its existence in your possession all of those years. In the same way you store Bitcoin, it's no different. And also this is true, obviously, of futures contract or currency contracts, FX. You can store yen, you can store pounds in the same way that you actually do, not physically, obviously, but in terms of bookkeeping contracts. So again, this kind of arbitrage is done. It's done at really high speed by high-speed traders, and you can see that, of course, this exaggerated example would never be possible because they leap on arbitrage possibilities when they just slightly get out of alignment. And because they do, they pull them back into alignment. The role of this kind of arbitrage is to keep these markets running fluidly. Now, therefore, we can say that these indexes and currencies will be relatively flat going out no matter what people think about the future. See, that's very important to understand. That means, of course, you can make directional bets that do not have the equivalent of premiums on options, for example, which if everybody was bearish, for example, the premiums on puts get really expensive, and it makes puts much more difficult to use. These futures contracts stay pretty flat because they have to, because of this class of arbitrage. When you take a look at the full range of what's possible for SPX futures contracts, saying we're starting at the price of $2,600, then the range at which this futures contract can deviate is indicated by these upper and lower limit lines. The red ones, the outside ones, are the 4% plus, 4% minus, and again, the 4% is the interest for the carry cost. The interior blue is 2% plus or 2% minus, and the green are what's current now, even less maybe than 1%. 1% plus and 1% minus. And it turns out, by the way, that today, when we look this up, that the September 20 futures contract, which is kind of the example we're using, except that that's not out 1 year, is at, I should say September 21 futures price, I think, is out, it's below the upper limit at 26.12. So I think that I should have said September 21 futures contract because we're talking about a contract that's a few months out. Okay, so again, the spot on 26 March was 26.30, and if you were to go after looking at the slideshow to CBOE and pulling up the contracts for ES or the SPX or the E-mini or any one of them, you'll only see 7 prices there, or maybe even 4, because there's only 7 futures contracts. There's the 4 quarterlies, and then there's a few, the December's going out, but you'll see they're all pretty tight. Right now, they probably show downward movement. They might show upward movement. I forget. Last time I looked, they were showing downward movement, slight backwardation, but they're not going to be way above or way below. And so one conclusion that we have to make is that futures prices can't be thought of as good proxies for expected future spot prices. You should understand that after hearing all of this, right? This futures price for, let's say, the next March 2021 contract is by no means a reasonable proxy where we think this market is going to be in March of 2021. It's always flat no matter what we think the market's going to do. That makes it very feasible for making directional bets that do not have much bias or premium or anything like that built into the bet. So we're left with a couple of takeaways, as we always are. So let's try to remember this, and especially try to remember this for the quiz. Although don't just study this for the quiz. Try to understand what this lecture is about, all right? The possibility of arbitrage will put an upper and lower limit on futures prices for storable commodities, indexes, and currencies. That's number 1. Number 2, that limit is determined by the carry cost for the contract, which always includes interest and can include storage, insurance, transportation, and other costs. 3, because index futures and FX or currency have only interest rates as carry costs, futures prices going out will always be relatively flat, constrained only by interest compounding or discounting. Therefore, these futures prices do not reflect the future expected spot prices of these indexes, except maybe directionally within the index. If they're slightly in backwardation, that probably means that the market thinks that the stock market's going to go down, although I wouldn't put all my money on that bet. And then 4, whoops, well, no, I guess there's only 3, not 4. That's it. There's 3. Only 3 things for you to remember. I thought there was 4, but I guess not. No, there wouldn't be, come to think of it. Okay, so that's kind of, that's a complex notion, but if you understand that about futures contracts, then you understand a lot about them. When you look at oil, you may say oil's in contango, and so you say on the same day, well, SPX must be also in contango. The market's so low, and it's not. What are you to make of that? Well, now you understand what you make of it. So when we come back, we're going to get into some of the more interesting stuff, actual trades that we can do. We can't do this kind of arbitrage. Our computers aren't fast enough. We can do contango trades if we want, and spread trades of all kinds. So that's what we discover and talk about next in part 3, mostly a discussion of contango trades. Right now, that's it, and we'll see you in a day or 2.